Okay, Assalamualaikum warahmatullahi wabarakatuh. So we meet again. Right, so this one will be the third part of the efficient market hypothesis, right? So, but this part we are looking at the behavioral challenge to market efficiency. Okay, right. So firstly, we go to the first point. Okay, how can, in theory, how can the market become efficient? Right, theoretically, okay, before we relate to the behavioral challenge, yeah, in theory, right? So in theory, in other words, right? We assume that all investors all investors are rational. So what the rational investors do? Okay, what rational investors do? So rational investors will make a rational investment decision. How is it? They will, if all investors are rational in the market, that means they will be behave in an identical manner, right? And they will take a quick action to buy or to sell the stock. So when they will buy the stock, when they will sell the stock. So since we assume all investors are rational, it means we will found that all investors will sell the overvalued stock and will buy the undervalued stock. So that means all investors will be acting rationally, right, in buying and selling the stock where they will buy the undervalued stock and they will sell the overvalued stock in order to make profit. So if all investors are assumed to be rational in the market and all investors are doing or making the same decisions of investment. So that means market can easily become efficient. Okay, so if everybody is rational. Okay, but in reality, what happened? In reality, however, in reality, not all investors are rational. Okay, or we might say that um, the investors are not always rational. Okay, they may make the irrational decision. Okay, right. So that is why we refer to the second point in theory. Okay, that means the market can still be efficient, right? Even though we'll have investors who are not rational in the market. Okay, so that means there will be an independent deviations from rationality, right? This one we can still, the market can still be efficient, right? By assuming the actions of those irrational optimistic, right, are offset by the um, actions of those irrationally pessimistic. Okay, so if many individual were irrational optimistic, as were as irrational pessimistic, prices would likely rise in a manner consistent with the market efficiency. That means the market can still be efficient as long as the number of um, the not the number, the action, as long as the actions taken by the irrational investors, which is irrationally optimistic investors, okay, um, are offset by the action taken taken by the irrationally pessimistic investors. Okay, right. In other words, we have same amounts of the irrational optimistic investors and irrationally pessimistic investors in the market. So they will offset each other. Then the market price of the stock can be at fair price. So therefore, it can result in efficient market. Okay, right. The next one, arbitrage. Okay, right. Arbitrage is actually the practice of taking positive expected return from overvalued or undervalued security in the inefficient market without any incremental risk and zero additional investment. That means the people will be acting irrationally to make profit. But then, how can the market become efficient if we have this kind of investors in the market? So here we must assume that, right, while many investors act on emotion, right, emotion, whether irrationally pessimistic or irrationally optimistic, right, and they can cause unrealistic price increases or decreases. Right, their action cannot be compared to the professional. Those actions terminate the market. Okay, so that means even though, right, even though in the market we have irrational investors, okay, we have irrational investors, the market can still be efficient. Why is that? Because, right, the market have professional investors, professional rational investors, okay, who will be acting accordingly. That means these professional investors will take action, right, in the stocks investment by buying the undervalued, right, and they will sell the overvalued. Kalau yang irrational ni, they might sell the undervalued stock and they might might buy the overvalued stock. So they um, take irrational actions in their investment decision. Okay, compared to the professional rational investors, they will do accordingly. Okay, the professional investors and rational investors here will act methodically, maknanya lebih systematic, okay, and more rational, right, by buying the underpriced stock instead of overpriced and by selling the overpriced stock instead of the underpriced. Okay, so if these professional investors is dominant, that means more than the irrational investors in the market, then the market can be efficient. Understand? Right. At first, just now we assume the market, right? All investors are rational, right? So if all investors are rational in the market, so the market can easily become efficient because everybody is taking the same rational investment decision by buying the underpriced stock and by selling the overpriced stock. And the second situation, what happened, right? However, some investors are not rational, right? Not all investors are rational, and sometimes the investors are not always rational. Okay, they may based on irrational. They may become irrational investors, right? So, but then the market can still be efficient. How is it market can still be efficient? By ensuring that the action taken by the irrational pessimistic investors and irration will be offset, okay, by the action taken by the irrational um, pessimistic investor. Okay, the action taken by irrational optimistic investors and irrational pessimistic investors are offsetting each other. Then market can become efficient. Okay, right. For arbitrage just now, what happened if the market consists of irrational investors and rational investors. Can the market become efficient? The answer is yes, as long as the professional and rational investors here is more than irrational investors. Okay, then market can easily be efficient. Okay, for independent deviations from rationality, just now we have two groups of irrational investors, right? Irrational pessimistic and irrational optimistic. For irrational optimistic investors, normally they are grouped under representativeness, whereby these kind of investors that are irrationally optimistic investors, they tend to draw conclusions very quickly, right? They tend to jump into conclusions very quickly using a little data or based on too small sample observed than the population. That means they get some information, a little information, or they use a little data about the company, then can they straight away or quickly, right, jump into the conclusion and make the conclusion. So this will lead to bubble. Okay, they will lead to bubble because they tend to overreaction, because this is like a gossip lah macam bahasa sekarang bawang, membawang kan. Kita dengar orang tu cakap sikit pasal seseorang, kita buat kesimpulan tentang orang tu. Samalah dalam kes ini di mana itu kita panggil representativeness. When we get too little data, then we straight away make conclusion. So that is what we mean by irrational optimistic investors. That is representativeness. And another groups of irrational investors is categorized as a conservatism. Okay, these investors, right, respond slowly to the new information. That means these investors, right, irrational pessimistic investors, are too slow in adjusting their beliefs to new information. Yang ini menyebabkan apa? Stocks price respond too slow to the new information. That means in this case kita, kalau analoginya ialah we take longer time, right, to trust that or to trust the informations that we receive from someone. Okay, right. So this will make the stock's price respond slowly. So this will represent the inefficient market. But the market can be efficient, right? Can still be efficient if what? If this bubble and this slow movement in stocks price offset each other, then market can be efficient. Okay. All right. Now, next we go to empirical challenges to market efficiency. What are the empirical challenges to market efficiency? So far, what we go through, okay, is about the theory of the efficient market. Okay, where what the market can be efficient by assuming all investors are rational. Okay, and then in theory we can say that market can still be efficient as long as the actions of the irrational pessimistic investors offset the action taken by the irrational pessimistic irrational optimistic investors and etc. But now we want to refer or look at the empirical challenges. Sorry about that, right? Okay, empirical challenges to market efficiency. So this is based on the research done by the academicians or by non-academician, right? So the first one is limits to arbitrage. Okay, so that means stocks prices rarely traded at parity. Okay, suggest limits to arbitrage. Just now I did mention that, right, the market can still be efficient. Okay, can still be efficient, right? Even though in the market we have irrational investors and plus rational investors, as long as what? Market can be efficient as long as the rational investors are dominant, dominant in the market. That means the actions of rational investors is more dominant compared to the irrational investors' action. Okay, right. Okay, the next one, earning surprises. Okay, uh, the earning surprises. Okay, based on the empirical challenges. In theory, if we say that the company make announcements of earning surprises, we could say that the market is going to increase, right? Something. This is something good about the company, right? So we may presume that the stock price going to increase or quickly to change to this information, right? Or quickly respond or reflect to that information. But based on the empirical challenges, empirical evidence, they found that the stock's price adjusts slowly to this announcement, earnings announcement. The investors shows conservatism, okay, conservatism, because they are slow to adjust to the information contained in that earnings announcement. Okay, another challenges is the size of the company. Okay, theoretically, we might say that the big company will outperform or have a good performance that as compared to the small company, right? In theory, but based on the research done, they found that the company with a small market capitalization will perform better than the large market capitalization. That means the small company's performance is better than large firms. And then value versus growth, okay, or glamour stock. Okay, value stock versus glamour stock. If we relates to the theory, all right, theoretically, people might say that the growth stock, okay, growth stock, that means the company that have potential to grow in future, right? So that means this stock will become more popular, more glamour, right? And in theory, we might say that these types of stock will have good performance as compared to the value stock. Value stock is actually the stock which is the stocks that of the established company, right? Established company or the company that already exists in the market. Okay, so which is not glamour in other words, right? So we found that on from the research done, right, the value stock is actually outperform the glamour stock. In other words, the growth stocks, okay, actually has less performance, okay, as compared to the value stock. Okay, that means value stock is better than glamour stock. Okay. Right, and this is another empirical challenges, which is crashes and bubble. Okay, right. So what is bubble? Bubble is actually an overreactions in the stocks prices. Okay, okay. The stocks market crash or drop is the evidence of bubble theory of market speculation. Okay, where the stock's price will increase significantly above their true values. Eventually, the stock's price will what decline, okay, until it reaches the fair price. Okay, example of this stock is the internet stock. Okay, long time ago when the stock first time introduced, right, this internet stock is very popular and highly demanded. So everybody is more interested in this internet stock. So this will make the demand for these stocks drastically increase. But then slowly after few years, right, this internet stocks price starts to decline, okay, or drops until it reaches the fair price. Okay, right. So temporal anomalies is also another challenges where, right, the research found that okay, average stocks return in January are higher than in other months for both large and small capitalization securities. And then they found that the stocks returns are highest on Wednesday and Friday compared to other days and lowest on Mondays. Average stocks written in US have been negative on Monday, right? And then another one is average stocks written are significantly higher over the first half of the month than over the second half of the month. So these are the empirical challenges of market efficiency that are contradicting from the theory. Okay. Right. The next one is the implications for corporate finance. Before that, right, at the very beginning, and if I'm not mistaken, in the first video of this particular topic, I did mention about the implications of the EMH for on investors and firms, right, where they cannot get the um, extraordinary profit when the stocks are already at the correct price, right? Of fair price. But here we want to look at the implications for the corporate finance. What are the implications of the EMH for the corporate finance? So in other words, if the market is efficient, what are the implications for the corporate finance as a whole? So for the first one, you can see that if the market is efficient, right, the price of the company stocks cannot be affected by the change in accounting policy. That means if the company makes an announcement saying that the company is changing from one accounting method to another method, let's say from LIFO to FIFO, or for depreciation from straight line method to the reducing line method, accounting method. So this information, accounting policies information here, right, announcement cannot be will not affect the stock's price of the company. Why is that? Because the changing, right, of the accounting policy, right, does not affect the actual cash flow of the company, right? It's only involved the earnings management, okay, earnings management of the company in order to reduce the taxable income, or in order to what, to increase the firm's value. That's all. It does not affect any real cash flow of the company. So that's why when the company makes an announcement of the accounting policy changes, so it will not affect the stock's price, okay, in the efficient market. Another implication that if the market is efficient, right, the manager or finance manager cannot wait, right, cannot wait or cannot time the issuance of stock and bonds until the new price. Why is that? When the market is efficient, right, we know that the security prices are already at correct price or fair price. So then is no use for the finance manager to delay or to wait or to time the issuance of stocks and bonds until the new price. Okay, all right. The next one, speculation and efficient market. So this is where if the markets are efficient, right, the firm can sell as many bonds or shares as they desires without depressing the share price or without reducing the share price, right, if the market is efficient. Okay, why is that? Because efficient market has the ability to absorb, right, a large number of stock or large blocks of stock without depressing the stock's prices. Okay. Okay, the next one, information in market prices. This is another implication where if the market is efficient, when the company make announcement, right, and then the stock's price quickly respond to that announcement, and that price changes will give information to the investors whether the company is doing well or not. Okay. So current and past price of any asset are known and can be used to forecast future market price. Okay. Market efficiency implies that stocks prices reflect all available information, or another situation that any price changes due to the announcement or new information will give information to the investors to make decision. Okay. All right. Another one, here we go to next part. We go to the misconceptions about EMH. Okay, right. Misconception, that means we wrongly interpret about the EMH. So that means here, first one, the first misconception here is the efficiency of dart throwing. Investors can throw data to select stock. So that means this is the first misconceptions about EMH, where some people or most investors might think that if the market is efficient, the investors can simply choose any stock in the market. All right, which is not right actually in reality. Why is that? Because in order to make the investment decisions in stock, or in order to decide or to make a decision which stock is uh, or should be included into the portfolio, the investors still need to analyze the risk and returns of the stocks. Okay, and they still need to decide how risky the stock, right, to be included into the portfolio. So it's not like the dart throwing, throwing the darts. Okay, if you want to choose the stocks, you still need to do the risk and return analysis. Okay, or you need to apply the risk and return trade-off theory. Okay, another one is that price fluctuations, another misconception. Okay, here is stated that when the prices of stock continuously change, investors assume that these fluctuations indicate market inefficiency. Right, so we cannot say that market is not efficient when there is frequent stocks price changes, right? We cannot say that. Right. On the contrary, such fluctuation shows that the market is actually efficient, right? Because when the stocks price change, right? That means the stocks price is actually what reflect to the new information. So that means the market is efficient. Okay, so we cannot assume that the market is not efficient when you found that there is a frequent fluctuations in the stock prices. Okay. Okay, the next one, shareholders disinterest. Okay, shareholders disinterest. So since only a small number of investors actively trade on any given day, some people misconceive that the market is inefficient, which is not true. So when you found that in the market, right, if there is a small number of investors who trade the stocks in the market, okay, small number of investors who are trading their stocks in the market. So we cannot say that market is not efficient. So this is maybe because of what the investors, because of the investors attitudes and um, the risk tolerance among the investors. Okay, so that's why we cannot make a conclusion that the market is not efficient when there is a small number of investors who actively trade their stock on any given day. Okay, the securities can be expected to be efficiently priced as long as a number of interested traders use the publicly available information. The market is still efficient actually. You cannot say it's not efficient. Okay, right. So this about the misconceptions about the EMH. So this is the um, tutorial questions or the concept questions that you can do later on, okay, in the textbook. Okay, and this is your textbook. Right, so I guess that's all for EMH topic, and I hope you will watch this video, okay, and try to understand my explanation. If in case if you still or you cannot understand with the explanations here, okay, regarding the EMH from part 1 until the last part of the video, then you can let me know. Okay, you are most welcome to ask me the questions, right? So thank you class. Assalamualaikum.